Hi, my name is Ryan Stark, and I'm the Director of Financial Planning and Participant Engagement here at Greenspring Advisors. During this video, we will review a few different ways to save for your child's future. Just like any other financial planning decision, it's helpful to begin with a clear set of goals. Goals will allow you to be more intentional about how much you save and especially where you save it. Is your goal to save for college? Then the 529 Education Savings Plan may be your best option. The money grows tax-free and comes out tax-free as long as you use it for qualified expenses. You may even get a tax deduction, depending on which state you live in. And keep in mind, these expenses do not mean college only. Qualified expenses include graduate school, technical or vocational school, K through 12 expenses up to $10,000 per year, apprenticeship programs, and up to $10,000 lifetime maximum on a qualified education loan. The $10,000 per year K through 12 expenses is a federal law, so make sure to consult with a tax professional to see how your state handles K through 12 distributions. Looking to give money in the future with no real obligation in mind? Then a savings account, UTMA or UGMA account may be the best option. With the savings account, the money is not invested but will gain interest, and the minor will take over the bank account once they reach the age of majority, which is 18 for most states but can be 19 or 21. While you may not get large returns, this is the easiest way to get started. If you're looking for more long-term growth, then the UGMA or UTMA, which stands for Uniform Gift or Uniform Transfer to Minors, allows you to invest your money in the stock market for the child's benefit. However, just like the savings account, the invested assets are delivered to the child at the age of majority, which, as you may recall, depends on the state. This account is taxed every year, so keep a lookout for a 1099 if you decide to use or already have this account. There's also something called the kiddie tax, which means you may have to pay taxes based on the guardian's tax rates rather than the child's, which will be much lower, maybe even 0%. Looking to jumpstart their retirement? While they will require earned income for this, a custodial Roth IRA may make more sense. The invested assets are delivered to the child at the age of majority, just like the UGMA or UTMA, but the growth is tax-free and can be an amazing start for their retirement. Can you imagine if you started saving for retirement the year you started working? That could mean 40 or even 50 plus years of compounding. Earned income can mean shoveling snow, cutting lawns, or babysitting, but it is important to consult with a tax expert to make sure you're filing and reporting income correctly. Besides goals, you know the personalities of those you care for better than anyone else. If you care for those who you believe shouldn't own your hard-earned money just yet, that may be a reason to keep it in your pocket and develop a plan that delivers the funds when they're more mature or you're more comfortable. This may also be a good reason to consider a trust to make sure the funds are used appropriately, even in your passing. All the accounts mentioned here today have a lot of little nuances that are well worth a discussion beyond this video. Don't hesitate to schedule a one-on-one with our financial planning team, and we're happy to help you develop a personal strategy around your specific situation. Thanks, and have a great day.